Hey everybody, it is time for the first Friday investing live stream here from Investing Unscripted. I'm Jason. That's Jeff. On a Friday, that's the first Friday of the month.
We did it.
Yes.
I'm a little sad. It's funnier when it's not on the first Friday, but hey, here we are. I think we're going to do first Friday in October too, but we'll see.
Yeah, I think so. So I'm going to derail us right from the beginning.
That's what we're here for, to be derailed.
So I have something in my hands here. And it looks pretty mundane, right? It's just a koozie, right? It's one of those like nice insulated ones. But here's the thing. This particular one, I 3D printed this at home. I 3D printed this here in my house.
Okay.
The 3D printer here. This is the logo for our local men's softball team. Like we have our own logo, and it's stupid, but it's fun. And I made like 30 of these for the guys on the team, but I've just printed them here. And the reason I wanted to bring that up is I think it's an incredible reminder that sometimes like these visions of the future that we have,
they're just early.
They're way early and they happen and nobody makes any damn money.
Yeah.
Like the 3D printer I have is from a company called Bamboo Labs, BAMBU. They're like the gold standard for a pretty nice 3D printer you can have at home that you can do a ton of things with. You can spend a few $100, you can spend a few $1,000, and they work. Like these, somebody else designed. I just bought the color of the filament that I wanted, and I used the app on my phone. Like I never have to design anything. Like it's just. But is
there like a template you can get, like beer koozie, and it has all the dimensions and everything?
In their app, they've got this community where there's all of these things, and people that design stuff and share it, they get rewarded, but you can buy like commercial licenses for things they design if you want to sell them. So it's pretty smart, right? But the key is like, this is on a much, much smaller scale. This is the internet. The difference between the late 90s and, I don't know, 2012, 2013, right? When the iPhone and apps and like all of that stuff started to become really ubiquitous, and streaming and, doing business on the internet, like all of those things, a whole lot of time passed and a whole lot of people thought they'd make money that didn't make money. 3D printing's on a tinier scale of that. So we may be in the middle of the same thing right now with AI, crypto, other stuff too. I just thought that would be kind of an interesting thing to bring up. Yes, I'm drinking a beer. Cheers.
I agree with you. I haven't said it recently, but one of the thoughts I had in the past after the whole AI thing, because it's the thing we always talk about all the time, I still believe that the big winners in AI are going to fall into two categories. I think the big tech companies that are spending all the billions of dollars now will probably be winners just because there wasn't an equivalent established tech, there wasn't established tech behemoths when we hit all that previous internet stuff, right? That was the beginning of that. So I think like 20 years from now, AI is going to be bigger. And I think that the big companies like Meta and Google and Apple, they'll all be fine. But I think like the big investing winners, like the Netflixes, the Amazons, the whatever, pick the stock that kind of came out of that time, are probably companies that have not been founded yet, right? They're
certainly not, they're not publicly traded.
No, I think it could actually be companies that were not founded yet. I mean, we are early in AI. When did ChatGPT come out? November of 2022. So this will be 3 years, right? Like, I think like there's going to be some 100-bagger stock when you and I are in our 60s that was founded in like 2029. You know what I mean? Like just after we've had, almost a decade of AI under our belts and everything. So yeah, that's a good way to start the show. Here's my question for the viewers and anyone listening later. You can email us and let us know. What is the...
You can send up a carrier pigeon, apparently.
Yes. True. Smoke signals work, Morse code, anything. We can receive it all. Western Union, another new way to send us things. Reminds Jason of his childhood.
New agreement we have in place.
So here's the question for everyone. What merch that can be 3D printed do we want to turn Jason's house into a sweatshop to make? We will overcharge for it. So just to be clear, like if it's $5 to make it, we're charging you 35 at least before shipping. But what is the merch? What do you want with our brand on it? And I'm volunteering Jason to make it hundreds at a time. And
dozens.
That's what I said, hundreds. And then just mail it out to you guys from his home address so everyone knows where he lives.
Beer funnels. Jacob Donkey Butt 10 in our live stream chat throws that out there.
All right, so as you're here, we'll remind you throughout the hour, but throw into the chat or email us later. What do you want? What merch should Jason quit his job to spend all day making?
Noah Kaufman, remembering that one of the important things about joining in the chat in the live stream is making fun of my hair. I actually printed a comb for my son. Like those, probably like Goody brand, like it's got the handle, but it's like the nice comb. I printed one of those. It's like a 75 cents worth of filament. It's
investing unscripted combs. It's on brand for like the hair jokes with you.
This is my favorite thing that I printed recently.
I like it.
Isn't that cool?
Yeah.
It's cool, right?
All right. Anyway, I just volunteered you to make a bunch of stuff for our listeners. So
no, you just volunteered me to make us a bunch of money.
All right. Let's talk about something. Let's talk about, I like how we start these shows just kind of doing a vibe check. Now it's only been a couple weeks since we did our last one of these because we did it on the 3rd Friday of August. So it's only been since the 19th, I think, or 18th, whatever that like Friday was. Ago. So here's my question for you, Jason, before we dive in. What has the S&P 500 done? Don't look this up. You have to answer this just based on vibes. We recorded that episode on the 15th of August. So 3 weeks ago. What has the S&P 500 done returns-wise since the close on August 15th through the close today?
So I was actually about to pull up like the year-to-date numbers, all that kind of stuff. So I stopped before I got...
You can't look. You have to just...
Excited. I know this.
Based only on vibes, what do you think the market's done over the past 3 weeks?
It's either down 70% or it's up 7%. Probably a little bit of both. Like, I know it's been volatile. And the vibes are volatile, leaning towards down.
Okay. So here's the answer. Oh, yeah. You know what? I'm going to wait. I'm going to wait and see if anyone else wants to chime in. So if you're listening live, the question is, from the close on August 15th to now, without looking it up, what do you think the market has done? And by market, I mean S&P 500. And I will give the answer in a minute. I will say what it has done and also the highest it has been up and the lowest it has been down over that time. Because I was surprised when I looked. I had a very different feeling in my gut and I was wrong about it. So we'll give it another minute or two. But we'll come back to that. So how are you feeling right now? It seems like we're going to get a rate cut, right? We'll talk about the jobs numbers. I think that was if anyone had hopes we would not get a rate cut, I think today's report was probably the nail in that coffin because it does seem like the job market has stalled out. Even before that, when the ADP numbers came out yesterday, I think the percentage chance of a rate cut jumped to like 97% or something like that. So looks like it's happening. But how are you feeling, Jason, as you just think about the market from like a 30,000 foot view?
So we got a couple of answers that have come in here. John Gallegos says up 3%. Jesse Merritt up 2.3%. Jacob says 0.4%, but Jacob looked it up. So there's our answer, right? But volatility, right? It's a couple of days it was down. Looked like it was for a few days there. It was definitely heading down and then started to recover and up and down, right? That's the day. So the market just doesn't know what to expect is going to happen next, I guess. But it's only a few weeks. So
I just was surprised. When I saw up when I looked earlier, I looked like half an hour ago, it was like up 0.5, but the market.
So my answer to that question, and I'm always the absolute worst barometer for this. I talk about this a lot because like the market to me climbs a wall of worry and like I worry all the way up. I really do. I'm always expecting, the shoe to drop. But because of the length of time between now and when my goals are, I don't let it affect my allocation so much. I certainly have. I mean, if there's one thing, like if I were to like say, okay, here's what I'm doing. I'm going to go look at my retirement accounts right now, and I'm just going to look at like stock buys. Over the past 30 days, I sold one stock. It was a company that I owned for a long time that was acquired by another company, and they merged together, and I decided to sell and move on. So the past 3 months, I bought nothing. I haven't bought any new stocks or added to any existing positions. I had some puts assigned to me in late July. TBBB Foods. I had some puts and it closed just a little bit below the price. So it was assigned. It was basically kind of a break-even deal. But I sold Solid Power. I sold Noble Corp. I sold Burford Capital back in early July. I sold some Lemonade. I think I've talked about that because it had become such an outsized portion of some of my wife's accounts. I can't tell you the last time I bought. I'm looking.
Well, so just pausing for a second on how much you.
April was the last time in my retirement accounts I bought stock.
So just knowing how slow you are to sell, that tells me you have been acting on the feeling that the market's overvalued for a while now.
For a while, and I think maybe yes, but I think the things that I'm interested in are a little richer than I'm willing to pay.
Yeah,
I think maybe a better way to put it.
I mean, our buddy Lou Whiteman likes to say, you can always find something that's cheap, right? If you're looking in the right places. But
it's true.
But that's a good point. Like that might not be the place you're looking to buy, right? So sometimes it comes down to not necessarily what the overall market's doing, but what the stocks you're interested in within that overall market are doing.
Yeah. In August, I bought the intermediate and long-term treasury ETF that I hold. I added to that across a few accounts. And in August, I actually did add to UPS in my dividend account. And also TFS Financial, which is a really interesting, weird bank. I bought some of that. UPS, turnaround stock, TFS Financial, just feels like deep value and a dividend stock that the market, it's a little misunderstood by the market. But yeah, in my retirement accounts, absolutely nothing.
Yeah, I think
options come into play there. You go ahead and then I'll talk about options.
I was just going to say, I've done nothing out of the ordinary, just my usual 1 to 2 times a month buying a stock. We did a rough cut exclusive for our Patreon paying members where I talked about maybe a little bit more direction within my feeling that I should be more aggressive in my stock portfolio. So one thing I actually have done since we recorded that is I took a good chunk of my cash that I had built up, probably a month's worth, so like 2 buys worth, and bought a bunch more of Warby Parker stock that I've been I've owned for a while now, and I've had growing conviction in it. And I saw some concerns. There's aspects of that business and frankly of that purchase of stock that I feel like are a little bit risky, but it just felt like the right place to take a swing for me for my portfolio and what I'm looking for. So, but I haven't really thought about anything since that buy, because I was sort of like, I used up all my money to do that. So we'll see what I come across next. I'm still struggling with, even in this market, I've ignored some pretty big winners that are small positions and not added to them. And I'm really struggling with whether or not I should add to them or not, if I should focus on some of the better value positions I'm still trying to build out, or do the add to my winners thing and buy some of the big winners. So that's kind of my next decision, I think.
Yeah, the biggest thing that I've really kind of leaned into in this market is definitely using options more. Because one of the things that I've found is there's a lot of great businesses that I've got a lot of conviction in, but and a number of them I already have a pretty decent sized exposure to. But the options market has created some opportunity where I can sell puts relatively deep in the money, meaning below the current price, and get a pretty decent premium. The risk, of course, if the stock price does fall below that strike price that I've sold the contract at, somebody else can put the shares to me, but they would be being put to me at a price that's substantially lower than the current price, which I don't want to pay. And even if it's lower than the stock falls below that strike price, it's the only way it's going to get put to me. I would still be happy to pay that price, and the premium builds in some margin of safety. So that's one of the things that I've learned is that's a way that I can generate some return in a period right now where a lot of the things that I like are overvalued and or expensive and already have a lot of exposure. So if I added, I would want to add at a lower price. But also I'm lucky because, Jeff, this is one of the things that we've talked about before that I think it's worth bringing up. More people are probably like you in terms of how their assets are laid out, where you have a Roth, you have a taxable brokerage, then you have your 403B, 401k kind of thing. And nobody's trading options in their workplace 401k, right? It's just not something that you can do in most cases yet. But you need to do options well and safely. Generally you need a pretty large portfolio, 6-figure. Generally there are,
you can do covered calls with a little bit of money. You're just super limited in what you can do.
Well, that's the thing, right? You're far more limited in what you can do. And again, I'm close to 50. It's a portfolio that I've been lucky enough to have been investing during this incredible bull run over the past 15, 16 years. So it's a pretty decent size. And that gives me a lot more flexibility with options to do things safely that are numbers that might seem kind of big, right? For people that are dealing with just a small taxable brokerage or a rollover or something like that, where all of a sudden the numbers like, this is a pretty big percentage of my portfolio I'm tying up to an option on this one stock. If it gets put to me, this one stock's now going to be 30% of this portfolio, and I'm not comfortable with that, right? And because, this isn't just a percentage of my retirement or assets, it's the vast bulk of my individual wealth. It's just the percentages make it a little bit easier to do and get more options. And for me, like from being able to sleep at night and not feel like I'm taking on more risk, it's worked out pretty well.
Yeah. I mean, when I was first learning about options, and we don't have to go down like a huge rabbit hole about options right now, but like there was these two worlds I was observing. There was the way I sort of learned about options, which was there's a safe, careful way you can do this, and it can be used as an income generating strategy, right? Mm-hmm. Which is one thing. And then there's the social media presentation of options, which is, crazy, risky stuff that either will destroy your portfolio or let you buy a Lamborghini next month, and I get hesitant talking about them to people who don't really know the right way, safe way to do it, because I think they conflate what I might say with what's out there in the world. And that is like, get rich quick, make big bets. And we are a gambling society right now. Like, whether it's sports, whether it's investing, whether it's futures contracts that are really gambling but they say are not, it's just like gambling is pervasive. And, you can blow yourself up really easily with options if you don't know what you're doing or if you're not careful.
Right.
So yeah, I mean, I got started really, really slowly several years ago. I'm talking like doing a covered call 3 months out that made me $39. Like I tied up money for 3 months to make like $40 because that's like all I could do. And you know, it was finally I learned enough to sort of do things on my own and feel a little bit more comfortable. But yeah, I think in the right circumstances for the right people who have the right background, it is an interesting way to navigate times like this, and it's a good way, I think, to scratch an itch if you are prone to over trade, right? Like do something. All right, let's dive into the comments here. John has a comment: if the Fed is going to get more dovish, it would be a tailwind for small and medium cap companies that need low cost of funding. It would seem all stocks, gold, Bitcoin will see higher highs for the next 12 to 24 months. Maybe. I'm not sold on either half of that statement. I don't know. I don't want to be a broken record on this, but a rate cut in September, let's just say we get a 25 basis point rate cut or even a 50 basis point rate cut. That alone isn't going to send us back to like 2021 when debt was free. So I don't know. And Jason, you tell me if you think I'm thinking of this the wrong way. I don't know how big of a tailwind that's going to be to the smaller companies that just need to take out debt to survive. Sure. Yeah. Like if I'm running a company, I'm happy to pay 1/4 percentage point or 1/2 percentage point less, but it's not like it's going to go from like a 6% loan to a 2% loan or a 4% loan to a 0.5% loan. Like it's not going to be that drastic, at least not right away. Now, if we see 3 or 4 or 5 cuts, or if Trump gets his way, we just see 3 percentage points at once, then yeah, that's going to be, putting aside what it might do to the overall economy, that's a much better situation for a smaller company that needs debt to survive. And yeah, I mean, what I'm interested in is to the second point of John's comment here about stocks, gold, Bitcoin seeing higher highs for the next year or two. I'm interested to see what the market does on the day the cut is announced, because it feels like that should be pretty priced in at this point.
Yeah, it should. Yeah, it should be.
Like I mean, maybe you'll see a little bump, but I can't imagine it's anything substantial. All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
So a couple of thoughts here. So it does seem like, and stock jockeys putting on their economist hats is always dangerous. But it does seem like the consensus thinks that what the Fed's doing is just nudging, right? It's not like we're necessarily going into like a bad, weak economy, but there are definitely some pockets of softness. Good band name. It's pretty good.
All right. If you're watching live, is pockets of softness a good band name? Yes or no? Put it in the chat. All right, continue.
It's just kind of nudging it, right? Nudging the economy. And I think the bigger thing is not necessarily, to your point, that 25 basis points, that just doesn't change the math for, like, most financial transactions. But it is just a little bit of a change in the tide. And then you start getting knock-on effects, right? Because then companies start to plan. And maybe it is the kind of thing where that 25 basis points makes the math more favorable for a home builder to acquire this plot of land they were thinking about, because it's going to make it easier for them to sell through some inventory of a community that they're bringing to market, right? And little things like that all of a sudden make it easier for them to plan and predict what's going to happen going forward. They have a little more money to spend. Maybe they bring on a couple new employees, or they retain people, right? And the people that are buying houses are like, okay, well, now I'm going to go to Home Depot and I'm going to buy all these things for the new house. So that's helped stimulate part of the economy. That pushes through to all of their vendors, right? And it's just this kind of like, I don't want to say it's the trickle down effect, because we found out back in the 80s that didn't work great, but it's true. The reality is it doesn't work with taxes, but it does work with the economy broadly, right? When there's more production and productivity, that carries through to all of the parts of the industry that supply and that are tied to that industry and the geographic area around it, right? We know that that's true. So, I mean, I think that maybe there's some truth to that. Really, what's going to drive the stock market and all of that stuff over the next 12 to 24 months is AI. Let's be honest. It's going to be artificial intelligence. How much AI-powered stuff gets sold? How much stuff to power AI gets sold? That's what's going to drive the stock market. That's 40% of the market right there.
I was just, from the standpoint of like, what will the index do? I agree with you. But I could see a scenario where the fundamentals and what companies report starts to weaken because the consumer pulls back, or inflation kicks back up because of tariffs, or there's some macroeconomic thing that makes all but the big tech companies, struggle. Like if we go through the next earnings cycle, let's just say when Q3 earnings, that's what, mid-October through the end of November, right? That'll be the next kind of earnings season. If we start to see, more companies miss, their guidance and profitability suffer and margins compress, but the index is okay because the Metas and the Nvidias and the Microsofts are doing fine, I agree and disagree with you, right? I think it could pull the market along, but I think you could see softening in the the S&P 593 or 493.
Right.
So I think both of those things could end up being true.
Ben Carlson wrote about the market and valuations and looking at the very long term versus the more recent long term. And he pointed out some really, really important things that's been talked about a little bit, but I think it is worth remembering. The companies we see, these biggest, most profitable companies, are unlike anything the world has ever seen in the world of enterprise ever before, just in terms of their cash generation and the level of profitability that these companies generate. It's nothing like, the railroads that, that were the biggest companies in the world, 90 years ago. So there's a lot of importance there. He also wrote about, even if you take, those biggest companies and remove them and just look at, the smaller companies in the S&P 500 from a valuation perspective, they're still a little expensive compared to the 30-year average, but they're a lot closer to that 30-year average than just those biggest companies. So the market's not as expensive as we think when you consider those two aspects, but it's still going to come down to, the how quickly does the enterprise uptake of artificial intelligence as a thing that's being sold really happen, right? That's to me, that's the biggest thing for the next decade, honestly, in terms of driving performance of the stock market as an entity.
Yeah.
Noah K asks, are we in a bubble? Somewhere, something. So here's my question for you. Which do you think is more likely to prove to be a bubble? And I'm going to clearly define bubble. A bubble, we could say .com, that was a bubble in that there was a massive expectation of future returns that proved wrong for many years before it was proved right. So that bubble popped, right? 25 years later, it's obviously it was true, but massive amount of permanent loss happened. Or you use 3D printing as the same thing, right? It's a technology that worked out, but just nobody made money, really anywhere in the public sphere. So which of these two things do you think is more likely to be a bubble? Artificial intelligence or cryptocurrency? Like the probability of the probability defined as the probability of permanent investor loss.
Oh,
whether in the long term it turns out to be a thing or not.
No, I think crypto for sure. To me, all right, so let me go through each of those. Crypto seems to me to be tied very much to the speculative gambling vibes that exist right now, right? And that is a newish thing. Like there was a little, there was obviously the newish in this sense, right? No, I forget where I said this, but I'll just say it again here briefly. When I bought my first individual stock, which was only in February of 2020, right? So not that long ago. Robinhood, which was the first brokerage account I used, didn't even have fractional share trading yet. Yep. And we were within, I think, a year or two of some of the other online brokers like Schwab and Fidelity even having completely eliminated their trading fees. Like we weren't that far away from that. They were gone by then. I've never paid a trading fee since 2020. But it was only in 18, 19-ish, like somewhere in there is when like all of that kind of fell apart. Also around 2020, like it was still not so common to like open up DraftKings and FanDuel and like to the extent that it is now, right? So just in these 5 years, you can't watch a sporting event. You can't go to the MLB app. You can't go to ESPN.com without getting inundated with gambling ads. And that has grown exponentially in the last, let's just say 5 to 7 years, right?
Yeah.
So, and what else has happened during that time? Meme stocks, crypto has taken off. You see all these stories, rocket ship emoji to the moon on this speculative stock, and then it goes down 99%. Like, it just feels like we are in this, that's what I think is a bubble. Like this time right now where this dystopian present we live in, where everyone is just gambling on everything, right? And now you can do futures contracts, like you can, which is gambling, but it's not regulated by the states anymore because it's regulated by the CFTC, and everything is just very frothy right now, speculation-wise. And I think that plays right into crypto. Yeah. AI could absolutely fall off a cliff. Like there could just be a quarter where NVIDIA misses its data center revenue estimates, or misses the consensus, and the stock drops 35% because it was a big shock to the system. And
my question is, what would it take for Microsoft and Meta and Alphabet and Oracle and these other big, Amazon, these other big buyers of NVIDIA's chips, the companies that make up the vast majority of their revenues, to all at the same time say, yeah, we got to pull back on this. Like, what would that look like?
I don't know. And I don't actually think it's going to happen. What I was going to say was like, while that's a possibility, I actually think it's unlikely.
Yeah.
Unless, this is the thing, and I don't really know a lot about this, so I could be completely off base. If anyone who's watching knows more about this than I do, feel free to call me out on this. I could see that happening if we run into a electricity generation wall.
Yeah.
Right. If we get to a point where like we just literally can't generate the power needed to like do all this, then I could see it just sort of like, like I said, hitting a wall and slowing down because of that. I think what's actually much more likely is without really it being perceived, because it'll just be built into guidance and then it will just sort of like slowly work its way through the market. The slowdown of spending, which is inevitable, right? You're not going to see this pace of spending forever. Now, could be a decade more, could be 5 years more, could be 6 months more.
Well, there's going to be a transition from the build out of capacity to the upgrade, right? Cycle.
So it's going to slow at some point.
And the question is, what does that transition look like? Because that's going to be really where the money is either made or lost.
Right. But what I'm saying is I think that transition, that slowdown is likely to be gradual, more likely to be gradual than a fall off the cliff. That's why like between AI, this is a long answer, between AI and crypto, if I had to pick like what's the bubble, no doubt in my mind, it's more likely that it's crypto.
To me, like one of the signs of like potentially another market top, and B just dropped this in the chat, SPACs, that was a bubble, 100 fake EV companies with no revenue. I mean, there was 1,000 companies with limited revenue that were just garbage, that were just being dumped on retail, right? So we're starting to see that the SPACs come up again. What's his name? Chamath? I guess he's got some stuff going on there in SPACs again. I mean, this is the guy that had a dozen horrible SPACs and one that's worked out in SoFi, right? So yeah, I think you're probably right. I think it's probably crypto. Certainly, like you look at the meme coins and the shit coins and all that kind of stuff that's out there. There's no doubt about that. Lewis Brooks brought that up. I will say, Jacob, thank you for defending Jeff and I's honor in the chat, by the way, telling John to shut up. Thank you for that. So, he does miss the Karl Marx haircut. So I apologize.
So
That's gone.
Colin,
I want to just real quick. I'm going to ask a question. Noah K. Wrote the whole housing market is propped up on these bad loans. It's a time bomb, and I want to short it. I'm curious what you mean, because I wholly disagree, but I'm not sure if I follow exactly what you're talking about. So I would love to hear you build on that a little bit more. Okay, go ahead.
I need to address Colin's comment. He says, I was 11 when The Sopranos came out. I just started watching it.
Good show.
I will never see Jeff the same anymore. All I think about is what character would he be? Innocent bystander, butcher shop worker number 3. So unless there's someone watching or listening who's from New Jersey, I don't think you fully understand. If you are Italian and you live in New Jersey, watching The Sopranos, which I did live because I'm older than Colin, I was an adult when it came out, was like watching, it was like me and my roommate at the time both grew up. I mean, he's 100% Italian. I'm half Italian. So I have like an Italian side of the family and then a non-Italian side. But like the best part about watching that show was just like the little nuances in the background, right? Like the lamp that Tony Soprano's mother had, that your grandmother had in her house. And it's all shot in New Jersey. So it's like, I was there. Someone got murdered in the town I lived in at the time that the show was coming out, like on the show. So that was kind of fun. So yeah, I'm not telling you what character I would be, Colin. But just, if our friendship falls apart, you'll find out.
That's brutal. That's it. Colin, it is very good too. Colin actually texted me to make sure we were doing the first Friday today. So glad to see you in the chat here. So Noah K says my only investing experience is The Big Short. I'm glad you shared that, because I want to say this, the fundamentals of the housing markets now are so incredibly different than they were in 2005, 2006, really through 2011 or so, when it finally started to get normalized. There was so much extra housing back then. There was this massive oversupply. Home builders had gone on just through this boom period in the early 2000s, really through the mid 90s, through the early 2000s, about a decade of massive overbuilding. And the entire finance industry started playing musical chairs, right? Everybody was competing for that customer, and financial innovation was all of these products that were nothing more than just lowering like your underwriting standards.
Well, yeah, I want to share a story about that, because I bought a condo in 2003. I sold it in 2005 and bought a townhouse. And by 3 or 6 months after we bought it, it was worth less than we paid for it because of just the bad timing. And I was only able to make that second transaction because of how ridiculously good the market was between 03 and 05, right?
Yeah.
Yeah. And that's not the part I wanted to bring up. What I remember distinctly was, so I bought the condo, first thing I ever bought. I was 23 years old, and it was like it was a small little place. It wasn't that expensive, but like it was one of those decisions where like the mortgage payment was cheaper than if I rented by myself, because my roommate moved out to move in with his now wife. So I was like, well, if I'm going to pay this much in rent, I might as well pay pretty much the same, a little bit more, and have something of value that I own, right?
Right.
But what I remember distinctly was I got the pre-approval for the mortgage. Now I am a second or third year teacher, right? So I think I was making, I don't know, $40,000 a year, something around there. I know it was in the 40s, and I think it was in the low 40s. And I got approved for a mortgage for like a $350,000 house. And I knew I could, because I did the math on it, like I knew I could afford something maybe half that. And I remember getting the letter and being like, this cannot be right. And I ignored it. I was like, I know what I can afford. Like, you can do the math on the mortgage payment. But that, and then same thing 3 years later, 2 years later, when we bought the townhouse, it was just like the process to get the mortgage was like, they literally like, I don't even know if they took my pulse. It was just like, oh, you're calling me on a phone. Here's all this money to buy something with. Fast forward to 2011, when I bought my current house. It was like giving up your firstborn, doing a blood test, like walking 3 miles on broken glass. I mean, it was a completely different experience. I was like, what is all this?
Yeah.
And it turns out that's what you're supposed to do. Like, you're supposed to have a standard and not let people overborrow, but just, I'll never forget that letter, like at 23 years old, being like, how do these people think I can afford this? And that's the perfect, I think, encapsulation of what the market was. And that is not what it's like today.
Right. That's exactly it. And Tyler and I just did a video it's on the YouTube channel, with our affiliate deal with the Motley Fool. And he brought North Point Bank shares to the table. I think we published that video today. If we didn't, it'll publish tomorrow. This is an example of like the good financial like innovation that we're seeing around lending. They've come out with a loan product that's both your fixed rate mortgage and a HELOC included together. So you have a fixed payment for the 15 or the 30 years to buy the house, and then the HELOC that you can use to do stuff to the house, right? So you pay a little bit higher rate than you would just with a mortgage, but it's a really attractive way for people that are looking to make improvements to a house versus current rates for HELOCs. It still has all the same high lending standards that you would get. And it's not like, no proof of income, no money down, the crazy stuff that they were doing 15 years ago. It's just a good quality product. So if you look across the industry at like the loan books that companies have, the loan to value ratios are extremely safe. Where if we had a massive recession and massive amounts of foreclosures, like even like approaching the levels of foreclosures that we saw during the financial crisis, obviously it wouldn't be good, but we don't have this massive oversupply of houses already, right? We're undersupplied. We're massively undersupplied because of a decade of underbuilding in the 20 teens. So the fundamentals are just not anywhere near where they were if we go back to then. So I don't think this is an opportunity. To the contrary, I've been pounding on the table for years that home builders are an opportunity, and writ large home builders have done really, really well for me. And I think home builders from today's valuations, over the next 5 or 7 years are going to do extremely well. So yeah, I think it's dangerous when you see something like The Big Short that works really well one time to think it's going to work again, and it won't. There's going to be something else that's like the black swan thing. Yeah. We don't know what the hell it is. It's not AI. It's not crypto. It's not housing.
Well, by definition, a black swan is something you can't predict, right? It's something you did not see coming. And that's I think the big, you hear the expression, the most dangerous words in investing are "this time is different."
Yeah.
But
when it comes to black swans, it's always different.
Exactly. Part of that whole thing is we're always fighting the last war, expecting the last big thing to happen.
Yeah.
And look, there are things that statistically and just looking at the world, you could say like that could happen again. Like here's an example. There could be another pandemic like that. There will be another pandemic. It's just a matter of like, will it be 100 years from now or will it be next month, right? You don't know. So like that is a thing that I wouldn't call that a black swan, not anymore. I mean, maybe you could have called COVID one because after 100 years you can say, okay, no one saw that coming. But if you listen to scientists, they will tell you that it is not only possible, but probable that we will have another one, and that will wreak havoc.
My wife works in public health, and she's worked in human infectious disease since her doing her postgraduate work, and she had been saying for a long time, there is going to be a pandemic in our lifetimes. She had been saying that for years and years before it happened. So, and even she was just as caught off guard when it finally happened as the rest of us.
Yeah. All right, we got a bunch of good questions here, Jason. Grab one. What do you want to hit first?
So Jacob, will you ever grow the Albert Einstein haircut again? Never say never. That's all I will say. But I will also say, my wife reminds me that Albert Einstein's rule of insanity, doing the same thing and expecting different results.
Mm-hmm.
So might not want to grow my hair back again as far as my wife's concerned. Andy Lee, Jason, will you add more of QuantumScape, ticker QS at this level? Why or why not? So I have a pretty decent exposure to QuantumScape through both stock and some options that create like a synthetic long exposure. So me, probably not, but maybe. I've been thinking about maybe adding a little bit more exposure. For other investors like me that own less, like you're willing to take on the risk that the whole thing still kind of doesn't work out, I think it's still really compelling. The stock's about $8 a share right now. They've made tons of progress. They have the deal with Volkswagen, the joint venture that they just expanded. Some people didn't like the Volkswagen part of the deal that Volkswagen got is that they can sell batteries. So it's not just for Volkswagen's use. They can sell a certain amount of the production. But then there's another joint venture with a still unnamed OEM. So there's clear interest from manufacturers that this battery technology is going to work, but they still haven't. They're just now like doing initial like light commercial production to prove that they can manufacture it at even just a low scale. I still think this time next year, we're going to see some high-end cars with like nice, expensive, like Audi high-end EVs with solid-state QuantumScape technology batteries in them.
I'll take the under
into next year. That's my prediction.
To me,
Jeff will buy one.
One of the things
money.
One of the things that QuantumScape gets me thinking about is like I don't view investing this way, but I kind of feel like I should, which is I don't know that I think about when I'm deciding whether or not to buy a new stock. Like I've thought about QuantumScape for a while now. It's on my watch list, so they say. I don't think of it as much as a risk reward calculation as I probably should. I think QuantumScape for a lot of investors that you see on the internet is one of those, I'm going to buy this because it's going to go to the moon and I'm going to become rich. Like that's the calculus. And I think if you step into it that way and it doesn't work out, it can be crushing both financially and just emotionally, right? If that's kind of your expectation. To me, QuantumScape feels like doing a risk reward calculation, right?
Exactly.
Like if I think this has a 60% chance of working out, I'm just picking a random probability here. What is that? What am I willing to put up? How much money am I willing to put into that bet so that if I'm wrong, I can still retire. And that calculus is different if you think it's a 40% bet that it turns out, or it's a 90% bet that it turns out.
Yeah.
I just hate losing money. Like that's the thing that's what held me back as an investor, honestly.
Yeah.
Like
well,
I have
this thing about a company like QuantumScape, dude, is the reality is that you can wait until they go commercial. And if it's still great, buying it then and holding it for the next 10 or 20 years should still work out exceedingly well without taking on that startup risk, right? That's where we are. Like B describes it as it's like a biotech in phase 2 clinicals. That's exactly right. This is pre-commercial. there's a lot of work that has to be done to prove that this is viable, right? So
Right.
that's the key.
Yeah, it's hard. Like I've said this before, like when you've been investing for decades, like both you and I have, whether you're like a stock investor or just if you've been diligently investing in the S&P 500 index fund for 20, 25 years, like, which is about as long as I've been, investing in retirement accounts, you get to a point where 1% of your portfolio going to zero will not change your long-term outlook. But 1% of your portfolio, if you just look at the dollar amount, is an amount of money you don't want to lose.
Yeah.
Like 1% of my portfolio when I was 23, like I still didn't want to lose it, but it was a much smaller dollar amount because I was young, So that's where I have to get myself, is to be able to take a little bit more risk in the stock portion of my portfolio, so that when I hit it, so to speak, like I use NVIDIA as my example of this all the time. When something goes up 800%, I have more than a few $100s worth of it in my account, because as much as that's nice to see, like it ain't going to change my life at this point, right? As if it were like $8,000 or 80 grand, it's a totally different story. So
a couple more things I want to hit real quick here, and we should probably try to take 2 minutes and talk about the portfolio contest before we do wrap up. Jacob says, what about office real estate? That is an area where there's still some weakness, but there was not this massive foreclosure collapse. You go back a couple of years ago when we saw Silicon Valley Bank failed and Signature Bank, and there was one other, First Republic up in Northern California failed. From that point, a lot of small regional and local bank stocks are still, a lot of those are still trading for really, really weak valuations because they have a lot of office real estate. But what have we seen? A lot more companies have said, okay, we got to go back to the office, or, our hybrid model is going to be more office and less remote. Office is not doing great, but it was not the black swan. It was not what people expected it would be. It's not great right now, but I don't think it's going to be this existential crisis that's going to threaten a bunch of banks. So there's that one. And Noah, what about labor market numbers? I think the short thing I can say there is that it's why the market was down. S&P was down about 1/3% today. So I think the report was probably, it was weak, but it was probably also weaker than probably the optimistic expectations. And it did kind of lock in, like we were saying, that expectation the Fed's going to cut rates later this month. But maybe a little bit less for a good reason, that it's just like, hey, kind of bumping the economy, and more like, hey, the economy's okay, but maybe it's a little less okay than we wanted. So maybe kind of a buzzkill on a Friday might be the way I think about it. It's not really changing the way that I'm allocating capital or thinking about the long term, because I'm not worried about, this month's rate cuts. I'm thinking, 10, 15 years from now.
Yeah. I want to answer a question or a comment from B from a little while ago. And I actually think I'd rather spend time on this than the portfolio contest, if I'm being honest, Jason. Because this is actually tied into something I thought would be fun for us to talk about. So B wrote, Moderna and ROKU, both near 500, were a major bubble, not to mention Zoom. And I think he's referring to like the valuations we saw with those companies during 2020.
During the pandemic, 2021 peaks.
And I agree. Having stupidly bought through all three of those companies at their highest valuation, I agree. But the thing I wanted to focus on was really Zoom, and I'd throw a couple other companies in this bucket too. But I've been thinking recently about this sort of phenomenon with some of these companies, especially these ones that were caught up in the pandemic craziness, right? So let's use Zoom as the example. Zoom was, for a short amount of time, and even before the pandemic, a legit growth stock, double-digit growth, a lot of users coming on board. And then obviously during the pandemic, that went parabolic. We're all shut down. Everyone's using Zoom. Fast forward to today, it's growing single-digit top-line revenue growth quarter after quarter, 5, 6, 7%, pretty consistently, but it is profitable and generates a ton of cash. I think people still hear Zoom, see Zoom, think about Zoom as a 30, 40, 50, 100% revenue growth company in their brain. And then they think it's a dead investment. Don't buy it. It's trash. It can't win. It can't work from here. But there's a lot of these companies. DocuSign is in this boat. I think Lululemon actually might be approaching this. Like, these companies, I think, can be steady growing, lower growth companies that maybe over time initiate a dividend, maybe become a total growth story, right? Rather than a growth story. But it's like, when do investors start to see them that way? When does the company itself start to see itself that way, right? Like, is Zoom ready to be a mature company that just generates a ton of cash and maybe pays a dividend for the next 30 years, right?
Yeah.
Or is Zoom trying to still be the Zoom of 2018 and the Zoom of 2019? Like, and I think there's a lot, I mean, you could put ROKU into that boat, right? Like they have done really well over a more recent time frame. And I think they still have a lot of promise ahead of them, but they're never going to, or I shouldn't say never, they shouldn't trade for the valuation they did during 2020 and 2021.
Here's the funny
Moderna is in a
thing.
different bucket because of, that's a different thing. But anyway,
Here's the funny thing that I think that's different about ROKU and Zoom. ROKU has continued largely to grow its revenues at a pretty decent rate.
Yeah, I was just throwing it in for like
have grown its users, like all that. It's expanded like its ecosystem of TVs that come with the tech, like all of that stuff. It hasn't created any value for shareholders in terms of like free cash flow and that kind of thing. Zoom has been a cash cow.
Yeah.
It is a cash cow. It is no longer growing. It's probably shrinking its enterprise user base, right? They adjusted it and I don't want to say it's a shell game, but they've kind of moved the needle a little bit on that a little bit. And it's probably hiding how much it's actually shrinking. They're just not growing or doing anything with all of that money they have. Like they announced these big share buybacks. Their share count's actually gone up since they announced them, right? So that's the biggest thing, is that one has made a ton of money, but it hasn't done anything with that money to create value for shareholders. Plus, I was super wrong about Zoom. I thought it had the potential, within 2035, I thought it would be a $1 trillion company. I really thought
it's a great example of, just because it's the best product that's out there for what it does, doesn't mean it could disrupt the fact that we all already have Teams on our computers.
Yeah, no, that's really it. I thought they were really going to just spread their wings and become this massive communications platform. And they couldn't get past somebody that was throwing it away that was more important for everything else. I mean, that's really it. So yeah, but B had a comment here. We were talking about QuantumScape, and B made a point in here to talk about the risks of a company like QuantumScape, and position sizing is really what it came down to. Taking a small percentage of your portfolio in these riskier investments versus having an outside risk. Sure, if it works out, you look like a genius, but it doesn't. Man, does it set you back if you have large exposure. So I think that's a really important thing to remember.
Yeah, no, I agree. I'm just fascinated by these companies that, like, I think B also mentioned Teladoc as being like one of those disaster companies from, and I actually haven't even looked at Teladoc in a while, but I truly wonder, like, for these companies that really became, the pandemic stocks, right? In quotes, if you could remove the pandemic memory from your brain, right? Or not see that on the stock chart and just looked at these companies fresh today, I think they'd get a lot more investor interest. And, maybe for different reasons. And I think the valuations would be different too. But I think it's one of those, like Peloton, that's another one. Like, they've had a hot mess of a last couple of years, but if you look at their last several quarters, they've kind of turned it around. Now, they still have work to do, but like, it is nowhere near the mess it was a couple of years ago. But it's always going to be a pandemic stock in my brain. It always, that's where it's going to live. So yeah, Zoom. I think Zoom's actually a good example here. It IPO'd in 2018, I think. 18 or 19, I forget.
It's 2018, maybe early 2019. Here's the point, though. Stock's up since the IPO 132%. That's like 14% a year. I mean, most people would take that. The problem is that in less than 3 years from the IPO, it was up like 1,500%.
Right. And if you bought it then,
it doesn't matter what it did from the IPO. It
Yeah.
matters what it did from when you bought it.
Right.
Yeah. No, I think it's exactly right. All right. So yeah, we're not gonna do the portfolio contest update. Sorry, people. There's a spreadsheet.
Well, here's what I'll say. Here's the biggest reason I have not touched it since 3 weeks ago when I said, I need to update.
Broke mine too. The shares for my Hershey position are no longer there.
No, that's for a reason I can explain to you offline. But
because he wants to make my results look worse than his.
What I said 3 weeks ago was I still need to update everyone's Redfin shares from when they got acquired by Rocket, and I still haven't done it. Don't worry, everyone. I have to update it at the end of September because we have to declare the Q2 winner, but I will get to it. But yeah, so let's skip that review for today. We'll hit it next time. But we're at the top of the hour here anyway, so.
Yeah, this one, B says, tech investors want unprofitable growth. They don't want Zoom, which is just profits and no growth. So, all right, yep, we're basically there. This has been fun, everybody. Thanks for the comments. Pretty active group in the chat today here. So, if you're just listening to the recording in your podcast app, remember sometimes the first Friday of the month we do the first Friday live stream on our YouTube channel. More often than not, it's the second, maybe even the third Friday. But if you follow us on social, you'll see it. Or if you subscribe to our Patreon, starter position plan, $5 a month in the Discord that we have, that you'll have access to, the exclusive Discord. We talk about it there too. So lots of ways you can be informed to join our live stream, First Friday live stream, if you're able to. It'd be great to have more of you watch it live with us. It's lots of fun interacting with you guys, because we don't plan for it. And mostly we talk about stuff that you guys ask us. So that's really helpful.
Yep.
All right. Any housekeeping, Jeff, or are we going to call it?
Now, let's wrap this thing up.
All right, everybody. As always, we love doing live streams. We love answering your questions. We love giving our answers to these hard questions about investing, finance, shitcoins, bitcoins, and artificial intelligence. But it's up to you to find the answers that are right for you. You can do it. I believe in you. All right, everybody. All right, Jeff, we'll see you next time.
All right. Thanks, everyone. See you next time.